Oh my God, I'm like really seriously late. I've never been 3 minutes late for like anything in my life. Well, I'm sure there's been some things in my life, but never a Rhino call. And just to quantify late, I was just on our call with Salesforce, which was 9 to 10 o'clock. And at the end of it, we got to so much nitty gritty stuff that I looked at the clock. I was like, oh my God, it's 10:02. Like, I gotta go. See you guys later. So welcome. But along those lines, this is the most people that I've seen once I press the live button, because I guess by nature, we're all like 2 or 3 minutes tardy. So it's good to see a full crowd right away. So welcome. We'll give it a quick second. All right, cool. So let's kind of follow up where we left off. I believe we left off last week with saying that we believe the market's getting closer to, hey, Celebration from Florida in the house, Deborah, that we said we were getting closer to a bottom. And it was for reasons of, and it was actually that we described it to be a slingshot move coming. Because the rationale was, and still is, that there's 2 separate dynamics in markets. There's the circus in town, and then there's the micro. And is the circus in town alludes to where's the money flow? Because you could have really, really bad businesses in a particular town, but if the circus is there, there's just money everywhere. It's got to go somewhere. So it's going to go ahead and patronize those really terrible businesses. And then conversely, you can have all the best businesses in the world, but if their circus is not in town, there's no money flow, then they're going to have to really fight for the scraps of whatever money is available. So when we said the circus in town, a lot of times it refers to the Federal Reserve. So for instance, last year when everything was great, and those that have been with us for that long actually remember, and I got an email from someone the other day saying, Ann, I went back and watched our 2021 tapes, our 2020 tape, well, especially the 2021, and there was a circus in town, but you specifically said that this time next year, the circus will not be in town because rates would have to move higher. And here we are. And it's funny because if you could watch things and see them a month back, a year back, or whatnot, and say, oh my God, right? Like we must have been amazing. But then when you're watching it day to day, you don't realize the little changes, and you're unable to realize the big changes, right? So like if you have a child, yeah, they look really different than that picture last year, but they look the same to you every single day. How does that work? Well, you're in water and it's just getting a little hotter along the way. So one would say, well, you guys probably did amazing, but when you're actually in it, only a little bit changes per day, and you kind of miss the big changes. The point being that when we decided and when we went ahead and described the circus in town, it was with the Federal Reserve. Rates were zero, they were printing money, quantitative easing, blah, blah, blah. If you had a pulse, you got like $600 a week to sit home. If you had like a good pulse, you got like $1,200 a week. All of that really, really fun stuff that our government did that everybody took, everybody voted for. And everybody said, oh my God, look at all this money. It's free. Cool. Well, guys, guess what? It wasn't free. We sat here and told you there's nothing that's free. And now you're dealing with the inflation that goes along with it. So now the Federal Reserve is tightening. They're raising rates, they're taking money out of the system. So one would say, and if the Federal Reserve lowering rates and putting money into the system is the circus is in town, then the Federal Reserve raising rates and taking money out of the system must mean the Federal Reserve must mean the circus is no longer in town. Well, the world is quite dynamic. If you have a linear form of thinking that you believe this equals this equals this, you will always be surprised, and more often than not, surprised because you're wrong, and you cannot understand why you're wrong. Because there are so many variables that enter anything. In fact, time is just a construct of your mind. It's your memories plus what you believe the future is going to be, but all you have is this exact second. Your life is simply just which room you're in and who you're in it with, and a series of that until you die. So when someone says, well, this equals this equals this, I never listen to that person. Well, don't get me wrong. I listen to them to gain inspiration of some variables that I'm missing, but it's far more dynamic than that. And the Eastern cultures, like the Asian cultures, really get it quite good. They've always believed in pi and dynamisty and cyclical thinking, which makes them really quite good. And when we're defining what quite good means, America has been around for, I don't know, 250 years, and we look like we're about to blow up. China's been around for like 10,000 years, at least. I don't know the exact number, but a lot, right? Like they've seen it and they've kind of figured it out by now. And God bless, right? So is the circus in town? Well, let's take a step past the Federal Reserve. Is there anything bigger than the Federal Reserve? Well, 99 times, no. But there is one time that there is something bigger, and that's the bond market. Well, Anthony, the Federal Reserve makes rates, that is the bond market. Sure, that's fine. But we're talking about the sovereign bond market. Okay, well, Anthony, the Federal Reserve makes rates about the US bonds. Yeah, sure. Does the Federal Reserve make great decisions about like European bonds? I don't think so. About Asian bonds? I don't think so. Does the Federal Reserve go ahead and are they able to change the dynamics of a bond? And what do I mean by that? Well, a bond is a promissory note, basically. I'm borrowing money from you. I'm saying, hey, listen, I will give you this bond. It represents $100,000. I'll give you 2% per year. You're going to give me 100,000. Great. I'm going to give you 2% a year. And then when the bond matures, I'll give you the 100,000. You made a good investment. I was able to borrow money from you. Great. Okay, that's fine. But what's further than that? Well, if I'm borrowing money from you, what's my credit worthiness, right? If I'm borrowing, well, am I going to pay you back? And if I do pay you back, is it going to be a currency that's worth more or worth less? And that's assuming that I can pay you back. What if I can't pay you back? What are you going to accept? What are you going to do about it, right? And what are the policies that we're allowing in this nation, right? Are we going to allow things to become more restrictive? Are we going to raise taxes in this nation? For instance, if you're lending me $100,000 for 20 years in Anthony land, well, it behooves you to know what the tax policies are of Anthony land, what the inflation policies are of Anthony land, the credit worthiness of Anthony land, and if Anthony even is going to pay you back, and if he does, what's it going to be worth, and what's it going to cost you to wait to get paid back? That's bigger than the Federal Reserve. Meaning, the Federal Reserve is clearly trying to take the circus out of town, but all of the other places in the world are not worth having money in. And we could go down the line of why you would never invest money. You would never send $1 billion to China. You would never send $1 billion to Russia. You would never send $1 billion to Africa. You would never send $1 billion to South America. You would never send $1 billion to Central America. And the thing that people don't understand about Europe, oh, we got the European Union, we have the euro, great, 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 was when they were selling to put the euro together, it was a twofold plan. But they did not believe they could get the second part in it to go ahead and create the euro. So they said, we'll wait for it. And here in the United States, the reason why the Federal Reserve is so powerful is because they make monetary decision about the whole country, right? They make a rate that the whole country abides by. And they do it based on the economics of the whole country. Why do I keep saying that? Doesn't that make sense to you, Anthony? Well, you're not telling me anything I don't know. No, Europe doesn't do that. Europe makes rate decision that affects the whole country. Well, the whole continent, I guess, right? Like the whole union. But each state has its own debt. Meaning, if they each have their own debt and they each have their own, earnings and GDP and all the rest of it, how can you make a one size fits all rate decisions? You can't, which means inevitably, by definition, if you cannot create something that can satisfy everyone all at once, there will be a point where it just blows up. Because if Germany has a really robust economy and Spain has a really bad economy, and Spain says, hey, listen, we need to lower rates. Germany's like, I don't want to lower rates. We're doing so well. If we lower rates, there's going to be inflation in our state. And then Spain's like, yo, why are you being so selfish? If we don't lower rates, we're going to all go bankrupt. When Germany's saying, well, we're so strong, and then Spain says, all right, you're so strong, we're going to go travel from Spain and go live in Germany. And then Germany's like, what the hell just happened? Why do we have all these people living there? All these people that came there that have nothing. Oh, because this whole, i.e. the United Kingdom leaving, right? The European Union. And it's just a lot of problems. So twofold, Russia and the whole East are waging war on the West, and Europe is right there front and center, i.e. Ukraine. Okay. Say whatever you want, but it is very clear, and even the Pope said it, that the Ukrainians are antagonizing the Russians. One, you might say to me, Anthony, how dare you say that? There's this war. Let me make something very clear. If you cannot win a war, you do not get into a war. And if you want to get into war because you believe the national pride of your nation is going to win it, then you do get into it. But at some point, you have to know when to get out of it. To go ahead and be receiving money from the whole entire Western culture to go ahead and supply you and arm you and stay into a war is basically, at least from where I'm from, you're selling out your country for the money coming into it based on you selling out your country. Because if Ukraine was not in war, they would not get any of the arms or any of the money from anywhere else. So at what point does money say, you're literally paying these people to go ahead and slaughter their lives? Be that as it may, that's a personal opinion. I'll take it with me. Not looking to start an argument with anyone. I just happen to see the economics of things, right? Point being, if Europe is not even protected from war, which, by the way, they have the worst geographic region to get into a war because everyone is right on each other. They all share the same border. So if this country doesn't like this country, they can like throw a rock and hit someone in the other country, right? If this Russia, if this nation, if this whatever doesn't like this nation, they're able to invade. So you wouldn't invest in Europe if you believe there was any type of war risk, right? And we're in war, so you wouldn't do it. But secondly, you would never send billions and billions of dollars to Europe, or at least the majority of your money, knowing that the rates and the monetary policy is unable to, by definition, cannot go ahead and make sure that it's safe across the board. And that tax policies, by definition, are going to be absolute risk. You don't know what country is going to do this, and if there's going to be austerity, or you just don't know. So where do you send it? You send it to the US. Now, you only make those calculations if the world is going in a direction that is scary, right? Like there's war, there's inflation, countries are losing money, they're going to go bankrupt. Okay. Well, that sounds pretty dire, right? So how can you go ahead and say that countries are going to go bankrupt? You don't know the economics of all those countries. You're right, I don't. I have no clue. I know that Australia probably, no, not Australia. I know Argentina has like a 40% inflation rate. I don't think their economy is necessarily good. I don't think any economy in Central America is good. I don't think any economy in South America is good. I don't think any economy in Africa is good, right? Like right off the bat, I just don't think that. China, I think, is good, but I think they're their own world. Russia, I think, knows what they're doing. They probably have the smartest leader in the entire world. That's not to be confused with the nicest, right? Like, guys, please, it's not to be confused that he should be the Nobel Peace Prize winner, right? But do I think he's the smartest? Yeah, probably. And he's buddy-buddy with China and them over there, so I think they're okay. Okay. India, I think the monthly income in India is like $200. I think they have 1 billion people. I don't necessarily believe that's a good economy. Okay. So why do I say all this? Because these are all what you call emerging markets, not India. Well, actually, India, for as long as it's been around, is still considered an emerging market because they're always emerging. Like every now and then they have this really, really great, like they rule the world. And then for the next however many years, they're emerging. They're like perennially emerging. And that's not to take respect away from India. They're like one of the, I think, are they Muslim in India? Because that's the #1 religion in the entire world. And I think they are, but the point is India has quite the influence in the world. So they're a really, really established country. Russia, it's been around forever, but they're still considered an emerging market because they're constantly emerging. In fact, I think the entire GDP of Russia is like $1 trillion. We owe $30 trillion, right? We owe 30 times more than Russia's even worth if you liquidated the whole country, right? Okay. Where am I going with this? Because these countries are considered to be emerging. Oh, Hindu, yeah. Thank you, Robbie. Because these countries are considered emerging, investors never wanted to give them money because, well, not that they didn't want to give them money, they never wanted to give them cheap money. They never wanted to give them money and give them the benefit of the doubt that they could never pay it back. In fact, when investors went ahead and purchased bonds in these countries or did anything in these countries, they did not do it in the local currency. No investor ever said, Argentina, I'm going to lend you money for 10 years at a 5% rate. Yeah, the Argentinian peso, we love it. So just keep giving it to us. In fact, we hope it's 50% inflation so we can lose our money even quicker. That's never been said. In fact, when Argentina looks to borrow money, they do it in US dollars. They say, hey, listen, we're borrowing money. Yeah, it's not going to be in the peso, so don't worry. We know we're not a good economy, but we will guarantee it based on our sovereignty, right? We are guaranteeing our bonds and we guarantee them in US dollars. Well, all right, US interest rates were zero. US bonds, the 10-year got down to 0.3%, but Argentina is 5, 7, 10%. And they're giving it to me in dollars. Well, gee golly, I'm going to go there. My money's best served by lending it to Argentina because they're giving me 7 to 10 times more than the US is giving me, but in the same currency. How did Argentina do that? That sounds crazy. Well, Argentina would go ahead and get money from the US based on the low rates. So the rates in the US, the borrowing rates and the Fed funds rates were zero. They would go to the US banks and say, hey, listen, we would like to borrow money. And the US banks are like, well, you are Argentina. I mean, you're a really bad economic country, but you're a country. And because you're a country, we can go ahead and, you got to guarantee it on your sovereignty and your land and all that stuff. But you're Argentina. I'm sure we could come up with something. And Argentina's like, yes, yes, please, please, please. So the banks would say, okay, we'll give it to you at like 5%. And Argentina's like, yo, you're getting it at like 0.2%. You're getting it at 0%. The banks are like, take it or leave it. Like, we don't care. We know you're a risk and this is what we want. So Argentina says, okay, we'll borrow the money at 5% and then we'll lend it out at 10%. Okay, cool, this works. We'll make our bonds 10%, we'll borrow from you at 5%, we'll go ahead and keep the 5% in between. No big deal. We could actually fund our lending. We could fund the money that we need to borrow. Let me get this straight. Let me correct that. We could fund the money we need to borrow by borrowing it from you. So we're borrowing it from you at 5%. We're then selling it out there for 10%. And one might say, well, that sounds kind of crazy. You pay 5% here, but you're paying 10%. And it's like, okay, we'll worry about that as the time goes on. Don't worry, that's like down the road. It's not now. Well, guess what happened? Now the Fed says they're raising rates. Okay, so what happens? Well, when you raise rates, the value of the currency goes up because you're taking money out of the system, which means each subsequent dollar that's in the system is higher in value, right? Less supply equals higher price when demand equals the same, if not higher, and the demand is higher. Okay. So what do you think Argentina's thinking? Wait a second. Hey, US, wait a second. We have to pay you back, right? Like, we borrowed money from you and you're making us pay back in dollars. They're like, yeah, I thought we understood this. Okay, yeah, we did. But the problem is then I went ahead and borrowed money from other people and told them I would pay them back in US dollars too. And the banks are like, well, that sounds like a bad idea. Well, it wasn't a bad idea when the US dollar was going down, because when the US dollar is going down, our currency is going up. You gotta remember, currencies are relative. Currencies aren't worth something in a vacuum. They're worth something against the other currency. So if the US dollar is going down, your currency is going up. And since the US is just printing money left and right, we didn't think that your currency would go back up, but now it is going up. Which means if your currency is going up, our currency is going down. So to go ahead and pay back in your currency, we have to sell our currency, which makes it go even lower because now we're selling it. And we have to buy your currency, which makes it go higher because we're buying it. So we owed this, right? Our currency was here and yours was there. Now your currency is here, ours is here. And by nature of us selling ours to buy yours, we're doing this. We can't afford that. In no world can we afford that. And then India is saying the same thing, Africa saying the same thing, South America saying the same thing, Central America saying the same thing. And you know what the US is doing? They're now raising 75 basis points. They're putting the pedal to the metal. They want to stomp out inflation. But in doing so, they're going to destroy and blow up the entire global economy because the interest rates and the value of the dollar is permeated within every country. So talk about a country that already has poor economics and then tell them that the debt they owe is actually multiplying every single day because they borrowed it in a different currency, in a currency that's going up, a currency that the entire world sees this and they're sending money to that country. And the more money they send to the country, the higher it goes up. And the more that you sell your own, the higher it goes up. So what happens? Well, it's really bad. Like every country just blows up economically. So what does that mean for the US? Well, if everyone knows every country blows up economically, they don't put their money in those countries. They send it to the US. So in this situation, the circus actually is in town. It's actually in town, bigger and better than it's ever been. In fact, the last time in our estimation, in our research, in our forecast that the circus has been in town like this was the roaring 20s. We believe we will get a crash, right? Like a really, really bad one. But we don't believe it's yet. And if we do get a crash, we believe it gets brought up like that. We believe the stock market doubles from here to 2032. And when we say double, the stock market's what, 30,000 on the Dow? We're talking about 60,000. So 30,000 points on the Dow. We believe that's the case. Because, and as you notice, I have not said one thing about, oh, well, this company has these earned. It doesn't matter. If every country in the world is taking their money and sending it to us for safety, it does not matter what any stocks are doing. The money's going to just find them. You'll see real estate value continue to go up. You'll see stocks continue to go up. In fact, the fact that stocks are going down is quite the opportunity. I looked at my wife this weekend and said, our son, we're putting $500 a month into his stock account. It's like mutual funds. We picked aggressive growth tech. So the market that's been getting annihilated the most, oh my God, tech. We've been buying it, the aggressive growth, like Facebook and Apple and Salesforce, all the really, really high flyers, the established companies that are going. That have been getting annihilated, down 30%, down 40%, down 50%. Well, if you buy $500 a month and the kid is like 9 months old, by the time he gets to 18, do you know what that account looks like? And I said to her, I was like, this kid is like so lucky. Not only does he have the best father in the world, not only does he have the best mother in the world, but he is like having his account funded at the best time ever. Now, could I be wrong? Could the stock market go to zero? I mean, I guess, right? But everything that I'm describing to you is something that you can understand. So when I'm coming up with a thesis that is to explain my hypothesis, right? It's not something you don't understand. If you live in Russia, would you keep your net worth in Russia or would you send it to America? If you lived in China, would you trust the communist government of China to go ahead and protect your money? Or would you say, I don't actually trust, like, let me send my money somewhere safe. If you lived in Africa, if you lived in South America, if you lived in India, if you lived in Australia, if you lived anywhere outside of America, would you ask yourself one question? Do you believe your money is safer in the country that you live in, your net worth, long-term investment money, or is it safer sending it to America? And I think if you're honest, you're going to find out that 100 out of 100 of those times, unless it's Switzerland, right? If I lived in Switzerland, I'm leaving my money in Switzerland. Every country outside of Switzerland, I'm sending my money to America. You know why? Say what you want about America. The fact that we have a new president every 4 years, and the fact that we have a new Congress and Senate every 2 years, the fact that this country was built on capitalism and money is guaranteed, the fact that we do have a printing press, the fact that we do have a Federal Reserve, the fact that we can do everything it takes to go ahead and constantly get refreshed, constantly make sure politicians and everyone are voted in after 2 or 4 years, meaning if some are doing a bad job and the country's going in a wrong way, they go ahead and get outed and the new guy comes in, theoretically. But the fact that we have all these things, the fact that we are perfectly positioned militarily, what are you going to do? Bring a tank in over the Atlantic Ocean and land in Virginia, or a tank over the Pacific Ocean and land in California? Oh, no, you're going to take a tank from Alaska and go down through Canada to get to the US. No. You're going to take a tank to go through Mexico to come up to the US. Have you seen Texas? They're just sitting on the border waiting to shoot you to begin with. There is no way militarily any country can touch us. And you might say, well, Ann, what about the nukes from Russia? Do you know we have turrets all through Europe? If Russia sent a nuke, do you think we wouldn't know this? We wouldn't see it? We wouldn't have like a bazillion opportunities to shoot it down? Well, they have these super duper duper fast ones. Do you think any country militarily is superior to the US? I just don't believe that. So even in the worst case scenario, I think we're really safe. And do I think America blows up? Yes, like economically. But when you are the biggest person or the tallest midget per se, everyone else has to fall before you. For you to get taken down, those guys got to get taken down first, right? So like, for instance, if you ever played a video game your whole life and you beat it, you get to the final level and you beat the final villain. Yeah, you knew you were going to beat him, but you had to beat all the other ones first. You couldn't just go to him and then, like, there's no way America goes down and Argentina stays up. It doesn't work that way. You could never do that. So for that reason, money goes where it's best treated. I believe that money will continue to go to the US. I believe that we're going to have the most roaring economy over the next 10 years as money just flows into this country. And it's despite the idiocy of our politicians. Let me just say that. So that's our commentary on the market. Let's take a look at where we are. I really have no clue, to be honest with you. So let's see where the stock market is today. And we'll go through some charts and all the other stuff. All right, so let's see. All right. So this morning, I went through and found all the new 10 red and greens on the daily level. They're all down here. I'm going to go ahead and clean that up and have that for you tomorrow. And by the way, so we are not doing emails just yet. Because we're in this transition period from our active campaign accounts. We completed our contract with them and we have a Salesforce account, obviously. And because it's so complex, we're very reluctant to go ahead and start just sending out emails yet until the account is done being set up. We have an agency we're working with that is granularly putting everything together. I was on the phone with earlier today. Oh wait, the stock market's closed today, isn't it? Is that real? Like, I think it's closed for Juneteenth. Someone's messaging me. I'll get to them whenever. Yeah, I think, hold on a sec. Maybe I'm losing my mind. Yeah, the market's closed today. Guys, so funny. So let's just take a look at, let's just take a look at something, right? Since we're here. All right, so this is a daily chart of the S&P. So this is price, this is volume, this is volatility. Let's see where we are. So price is coming down, right? During that same period of time, volume has been going up and volatility has been going up. That's really bad, right? Like, and obviously we can see why it's so bad. Now, is that lasting? Well, what's been going on the last couple of days, right? So let's do that. So this looks like it's steady, right? It's going sideways. Okay. This looks like it went down. And this looks like it went down. So if you have volume going down when it's steady and volatility going down as well, it sounds like maybe the selling is exhausted, right? Less selling, and the market was down technically, right? And there was less selling. And volatility is coming down in the sense of people saying, okay, we're getting a grip of this, which means we would believe that near term, we should see a bounce higher. Let's see. Because as you see this selling, look how high this volume is compared to this. So when we identified it had its channel, volume was very lackluster. Then it came down, all the volume picked up. But as you see the volume from this point, it's going down, even as the market's been going down. And volatility been going down as well. So we think it's exhausted. We think we're looking at something higher. Again, we are waiting for a slingshot move. We believe once it goes higher, it's going to fly away. Does that happen immediately? I don't know when it happens. I know sooner than later. But because the market's not open today, none of these little lights are flicking, which means I cannot give you the most recent numbers, red and green, but we will have them for tomorrow. So I'm going to leave it there because my day is super duper duper and I just found some time. Yes, it's Juneteenth. So with Juneteenth, I thought that was June 19th. But I know it's a national holiday. So I guess that's why Mondays close, which is fine. I love it. And Juneteenth is an important date. I know it just became a federal holiday last year, but it should have really been known for quite some time. And I know there are communities that do know it, and it's good that the rest of the nation is learning it, because the best time to know anything is 20 years ago and today. So if you could start learning today, then that's better than not learning, which I'm totally cool with. So let's do that. I love everyone. I'm going to be on Wednesday, 2:00, Rhino Street. Really, really big day. We have our new animation done. We're going to have the promo packages done. Well, I don't want to. We're going to have the promo packages done Friday for everyone. A lot of good stuff. So let me run now, and I will see everyone Wednesday. Love you guys.